the author of the first paper will be Robert Hetzel, who is formerly of the Federal Reserve Bank of Richmond. Bob has his PhD from the University of Chicago, where he studied under Milton Friedman. Over the years, Bob's research has focused on the evolution of central banking under a fiat money regime, and he has a couple books published by Cambridge University Press, The Monetary Policy of the Federal Reserve, A History, and The Great Recession, Market Failure or Policy Failure. Our second author is George Selgen, and George is a senior fellow and director of the Center for Monetary and Financial Alternatives at the Cato Institute and professor emeritus at the University of Georgia. George has written numerous books, and he holds a PhD in economics from New York University. His most recent book is entitled The Menace of Fiscal QE, published by the Cato Institute in 2020. Our third set of authors consist of Forrest Cappy and Jeffrey Wood. Forrest holds a doctorate from LSE and taught at the University of Warwick and the University of Leeds. He's been a British Academy Fellow at the National Bureau in New York, a visiting professor, scholar at several different places. Forrest has written widely on money, banking, trade, and commercial policy, and recently published The Commissioned History of the Bank of England from Cambridge University Press in 2010. And his latest book is Money Over Two Centuries, which was published by Oxford University Press in 2012. Jeffrey Wood has lectured in economics at the University and in banking and finance at City University London, where he's been a professor since 1986. He's been a visiting scholar at numerous places, including the wonderful Federal Reserve Bank of St. Louis, where I work, and he's acted as an economic advisor to various firms and organizations. Jeffrey's the author or co-author or editor of over 20 books and has published over 50 papers in academic journals, including a number of books about financial regulations and public choice. Perhaps most significantly to me, Jeffrey is a former co-author of mine. All right, so we will get going and with the first paper delivered by Bob Hetzel on the U.S. Fed response to COVID-19 crisis as compared to other global financial crises.
Okay, since I have 20 minutes, I'm going to concentrate on the first part, the U.S. Fed response to COVID-19. But let me say first that I want to thank Tim and Juan for setting up an excellent and relevant seminar. And also I want to thank their able assistants, Gail and Kobe. Now, you all deserve to go out for a beer tonight, but one of the tragedies of the COVID crisis is that the pubs are closed. So I don't know what you're going to do, but I hope you can do something relaxing. Okay, let's start. So, Kobe, if you'd put my graphs on. Okay, the graphs show vividly why we're here today. In the spring, there was a huge bulge in the money stock, accompanied by unprecedented open market purchases. Figure 1 shows the drastic expansion of the Fed's asset portfolio due to open market purchases. And at the zero lower bound, open market purchases represent direct money creation. Figure 2, Kobe. And you can see this shows the various QE quantitative easing programs, with QE4 obviously open market purchases of treasuries and mortgage-backed securities started in March. And you can see how aggressive the current policy of money creation has been. And then figures 3 and 4, Kobe, show the surge in bank reserves and deposits. Okay, so now I'm just going to talk. Okay, in the past, this kind of money creation would have led to inflation. The current money creation represents an accumulation of spending power by households. The question is whether the Fed will follow a policy that unwinds the spending power by unwinding the bulge in money, or whether it will allow an uncontrolled surge in inflation, an uncontrolled surge in spending that unwinds the spending power through inflation. And that's exactly a question that Tim and Juan asked. The presentation here is going to first review the FOMC's current monetary policy. It will then compare the current policy to the monetary policy of the Great Inflation and the subsequent Great Moderation policy of the Volcker-Greenspan era. The concern here is that the current policy more closely resembles the monetary policy of the Great Inflation than that of the Great Moderation. If that is right, then the bulge in money will not be unwound by Fed policy, and it will lead to inflation. Okay, let's start with Chairman Powell. In August 2020, in a speech that was part of the Jackson Hole Conference, Chairman Powell used a revision of the FOMC's statement on longer run goals and monetary policy strategy to announce a new strategy for monetary policy. According to Chair Powell, the FOMC can run an expansionary monetary policy to achieve an unemployment rate low enough to achieve socially desirable goals. The reason is that the world has changed so that even with low levels of unemployment, inflation does not emerge. That is, according to the new doctrine, the Powell doctrine, the Phillips curve is flat down to historically low levels of unemployment. Monetary policy can then be expansionary until inflation rises persistently above the FOMC's 2% target. And that way the Fed will discover this new very low NAIRU. The policy followed in the era of the Volcker-Greenspan FOMCs of raising the funds rate during economic recoveries to forestall the emergence of inflation, a policy known as preemption, is now undesirable. It's been ruled out, and that's key. Powell called the new policy flexible average inflation targeting, FATE. As connoted by the adjective flexible, with achievement of some vaguely defined overshoot of 2% inflation, discretion then replaces commitment to an explicit reaction function. Instead of the prior 2% inflation objective, the FOMC has adopted a policy of managing inflation around that objective. To repeat, central to that management is abandonment of the Volcker-Greenspan policy of preempting increases in inflation. That is, the FOMC has abandoned the practice of raising the funds rate during economic recoveries to prevent the emergence of inflation. The discretion allowed by ambiguity over the FOMC's reaction function once an inflation overshoot is achieved suggests that the Powell policy review was primarily an exercise in outcome-based forward guidance. By committing to a liftoff of the funds rate from its zero lower bound only after inflation exceeds 2% for an undefined but persistent period, the FOMC was telling markets not to raise bond rates as the unemployment rate declines. To reinforce that point, the policy review emphasized that the FOMC would ignore evidence that the unemployment rate had declined below a sustainable level, typically called the NAIRU, or non-accelerating inflation rate of unemployment, and proxied for by longer run unemployment in the FOMC Participants Summary of Economic Projections, the SEP. To use Keynes's phrase, expansionary monetary policy is to be followed à outrance, and make no doubt about it, at the zero lower bound, as long as there's a vigorous program of quantitative easing, there is direct money creation, and if continued long enough, it will lead to inflation. Now, the conflation by the Fed, the FOMC, of a reaction function with forward guidance committing to an expansionary monetary policy leaves the reaction function incomplete. The FOMC offers no information on its behavior after the desired inflation overshoot, flexible. Also, commitment to an expansionary monetary policy precludes a response to incoming information that presages a robust recovery in inflation with an unemployment rate that remains high relative to pre-pandemic levels. That's a point that Mickey Levy made. The FOMC will fear that any attempt to back off from its commitment to a low funds rate will cause a large discrete upward movement in the term structure of interest rates and make monetary policy undesirably restrictive. The relevant predecessor is the Taper Tantrum of 2013. The FOMC's announced intention is to raise inflation above its 2% target, especially in the Great Inflation lasting from the mid-1960s through the early 1980s. The Fed did raise inflation, but never in a controlled, desirable way. The FOMC's current policy of flexible average inflation targeting offers no information on how the FOMC intends to control the degree of the overshoot in inflation and then restore it to 2%. The FOMC bases its strategy on management of an employment gap, the difference between the unemployment rate and the NAIRU. At the same time, the FOMC offers no evidence of past success in such a policy. Just as important, it offers no evidence concerning how it will control the expectations of inflation by the public. The issue of controlling inflationary expectations will become important when the FOMC tries to restore 2% inflation after having achieved the desired inflation overshoot. It will need to slow economic growth at that point without causing a recession, the proverbial but elusive soft landing. So in time, the FOMC will need to raise the funds rate. By achieving credibility for price stability, the Greenspan FOMC made it possible for the FOMC to lower the funds rate aggressively without reviving inflationary expectations. Once the public sees inflation rising, however, the FOMC could lose that credibility. That loss of credibility would then render difficult the ability of the FOMC to reverse a contractionary monetary policy, to reverse the overshoot, in a way that prevents the economy from entering recession. The concern here is that the Powell policy is a return to the policy of the Great Inflation. As background, note that all monetary policies since 1951 represent some variant of what William McChesney Martin called lean against the wind. I call it law. With these procedures, the FOMC would raise short-term interest rates above their prevailing value when output was growing persistently above trend and rates of resource utilization were steadily increasing, the unemployment rate was declining. What I call law with credibility entailed preemptive changes in the funds rate during economic recoveries, sufficiently large to preserve price stability by preventing the emergence of inflation. In contrast, law with trade-offs characterized the Great Inflation, where trade-offs refers to the attempt to use the empirical relationships represented by the Phillips curve to trade off between inflation and unemployment objectives. During economic recoveries, the FOMC raised the funds rate in the 70s only reluctantly for fear of aborting the recovery. The focus of monetary policy was on returning the unemployment rate to its full employment level, assumed to be 4% or lower. Nice pre-pandemic unemployment rate. Only with the actual appearance of inflation did the FOMC become willing to raise the funds rate significantly. However, when recession developed, the FOMC became unwilling to lower the funds rate out of a concern for sending the wrong signal to the markets that it was willing to tolerate a higher inflation rate. Law with credibility emerged out of the desire of the Volcker and Greenspan FOMCs to restore the expectation of price stability lost in the previous stop-go era. That overriding objective imposed two kinds of discipline that forced the abandonment of attempts to manage the inflation-unemployment trade-offs apparently offered by the Phillips curve. The first kind of discipline imposed in the Volcker-Greenspan era derived from the imperative to eliminate the market's association of cyclical strength and the economy with the emergence of inflation. As a result, the FOMC had to remove cyclical inertia in its interest rate target during economic recoveries. It had to follow a policy of preemption. The second kind of discipline derived from the way that stop-go monetary policy had conditioned markets to extrapolate expected inflation from actual inflation. Inflation became a random walk. The FOMC adopted preemptive increases in the funds rate so that inflation did not emerge during economic recoveries. Specifically, during economic recoveries, the FOMC raised the funds rate in response to cyclically tight labor markets as a harbinger of inflation. The stop-go monetary policy of the 1970s rested on a Keynesian model with a structural Phillips curve and exploitable trade-offs. The change in the monetary regime that occurred with Paul Volcker rejected this model. The optimal policy became price stability, no trade-offs. A policy of price stability carries a strong implication. The central bank should allow market forces, that is the real business cycle core of the economy, to determine real variables like employment. The change in monetary regime that occurred with the Volcker-Greenspan FOMCs constituted one of the great monetary experiments of all time. The Great Moderation replaced the monetary instability of the 1970s. I think the Fed is being myopic and not looking back to the period of the Great Inflation. In many ways, the current period is reminiscent of the 1970s, the current political environment. American society was then fractured over the Vietnam War and civil rights. The United States has always divided to some extent between rural, populist, urban establishment camps. The Scopes trial pitting William Jennings Bryan against Clarence Darrow was iconic. In 2020, this historical fault line widened, not only in response to the pandemic, but also in response to the longer-run forces of technological change. The combination of skill-biased technological change and urban agglomeration externalities created losers in the less educated rural camp and winners in the more educated urban camp. The resulting political polarization has created the demand for simple solutions that identify globalization, trade, and immigration as scapegoats. Just as in the 1970s, the current societal division makes imperative the low unemployment rate created by a strong, growing economy. Starting in the 1960s and continuing in the 1970s, the Fed responded to that political imperative. Within the prevailing Keynesian intellectual consensus of the time, economists promised to deliver a low unemployment and a politically acceptable inflation rate. At present, the analogous objective is to pursue an expansionary monetary policy until inflation rises persistently above 2%. Just like the first half of the 1960s, the expectation of near price stability is firmly embedded in the public's behavior. The lesson from the expansionary monetary policy that followed the first half of the 1960s is that with the embedded expectation of price stability, expansionary monetary policy can drive the unemployment rate well below its sustainable level. The ultimate cost was inflation. As documented by Friedman, inflation arose with a long lag of almost 2 years after the overshoot in the sustainable unemployment rate. And here I have to differ with my wonderful friend Lars Christensen. I don't think Eugene Fama efficient markets were present in the 1960s when it took the market so long to adapt to a change in the monetary regime. At present, the FOMC wants to raise inflation. Earlier, it did so in 3 waves, starting in 1966, 1972, and 1977. However, these increases in inflation were unintended. If they offer a lesson for the present relevant to raising inflation in a controlled way, it is the importance of maintaining control of the expectations of price setters about inflation. Unfortunately, economists and policymakers know very little about managing expectations. That ignorance suggests caution. The current Powell FOMC experiment in replacing the public's expectation of price stability with the expectation of inflation assumes the ability to manage that expectation in a controlled way. No doubt a sustained monetary expansionary monetary policy will raise inflation. No doubt sustained inflation will raise expected inflation. The issue is whether the FOMC can move inflation and expected inflation around in a controlled way, first up and then down. There is nothing in historical experience that suggests success. Historical experience suggests the alternation of inflation and recession. So, is expansionary monetary policy a harbinger of inflation? Starting in March 2020, with the unfurling of the pandemic, the money stock surged at an historically rapid pace. Commitment to an expansionary monetary policy suggests that the FOMC will not, at least purposefully, follow a policy that allows the bulge in money to dissipate. Experience most recently with the Great Inflation suggests that the result will be an uncontrolled surge in inflation. What policy should the FOMC follow in order that the increase in the purchasing power created by this bulge in the money stock dissipates through a reversal of the bulge rather than through a rise in spending that creates inflation? It must follow a policy that unwinds the bulge in money. In the spring, the FOMC financed the transfer payments made in response to the pandemic through money creation. During the recovery from the pandemic, the FOMC must unwind that bulge, even if it means raising the funds rate preemptively before a significant inflation overshoot occurs. There is reason to be concerned that the FOMC has gotten itself into a box in this respect. The FOMC forward guidance through the SEP and Powell's press conferences promising a funds rate at the zero lower bound for the indefinite future make the Fed into a passive player and the Treasury into the active player, George Selgen. In the long run, the government budget constraint will hold. The question is whether budget balance occurs through money creation and inflation or through fiscal discipline. So I'm going to wrap up now, 1 more minute. The recently announced monetary policy rejects the policy followed by former FOMC Chairman Paul Volcker and Alan Greenspan of raising the funds rate preemptively during economic recovery so that inflation never emerges. According to the current policy of the Federal Reserve, the FOMC will raise the funds rate only when inflation persistently exceeds the FOMC's 2% inflation target. Based on experience during the Great Inflation in the 1970s, this policy risks an uncontrolled rise in inflation followed by recession. Inflation has for some time modestly undershot the FOMC's 2% target. The solution is not to return to the policy regime of the 1970s. Like policy in the 1970s, the FOMC's current policy of flexible average inflation targeting is asymmetric in its emphasis. The emphasis is on offsetting low inflation with higher inflation as a means of lowering unemployment to its pre-pandemic level. At the same time, the FOMC leaves unclear how it will eventually eliminate the desired inflation overshoot when it does occur. In the long run, this policy risks an unanchoring of inflationary expectations and a return to the inflation and monetary instability of the 1970s.